What I'm going to do is essentially to talk about where the world economy is. I'm going to motivate it by talking about IMF forecasts, because the IMF has repeatedly got the forecast wrong over the last 5 years. And the question I'm asking is, why has that happened? And I'm going to use that to say that's because there is a fundamental lack of understanding of how the global economy has functioned in the last 5 years. Then I'm going to look at 3 different ways in which people who are thinking about this are explaining the working of the world economy, and propose one alternative which I favor, and give you a little sketch of what that means, and then conclude by looking into the next 2-3 years and tell you why the recent market tremors that we have seen in the last few weeks are actually meaningful. So again, there in the last few days, those of you who follow this may have seen that a number of very eminent commentators, economists, have said, don't worry about this, this is a passing storm, global fundamentals are basically fine. And I'm going to tell you why I think that economists may be getting it wrong again, and then the markets might actually know something that economists don't know. Okay, so in 2010, April 2010, World Economic Outlook projects world growth 5 years ahead. And it basically said that the crisis is over. World growth is coming back to 4.5%. And in 2015, the world will be growing at 4.6%. In April 2015, 5 years later, the same World Economic Outlook forecast a growth for 2015 at 3.4%. And by the end of the year, it has come down to 3.1%. And my own reading of the data, which I basically calibrate by world trade, which is a high frequency number, is that world growth this year will probably be less than 3%. So instead of the 4.6% that was forecast in 2010, world growth is likely to be 3% or even less. That's a huge gap. And it's not that this is an exceptional year. These forecasts have steadily come down. They've been whittled down over the last 5 years. And every time growth has come lower than was forecast, the IMF and other forecasters have said, oops, there was a tsunami in Japan, or the winter in the Northeast America was too severe, or there's a recalibration of risk occurring, or the supply chains in Thailand were disrupted. There was always an exceptional reason why that particular forecast was not validated. But don't worry about it. As my younger son Lakshman would say, don't worry about it, because growth will pick up next year. And then next year would also not happen. So this is a sort of standard pattern. I wrote a piece 2 years ago. I called it the Groundhog Day economics of the IMF. So at that time, it was a little bit of a joke. It was a bit, it got a lot of laughs. It was very widely read. But the question is, why does it keep happening? So there are 2 different views on why this happens. So one, let me call this the Reinhardt-Rogoff view. I think the Reinhardt-Rogoff view is the right place to start, because Reinhardt and Rogoff essentially started in 2009 in which they made the claim that a financial crisis is one where the recovery takes a long time to occur. And Ken has been continuing to make that claim. He sometimes calls it a garden variety financial crisis. He says any financial crisis of this magnitude, it takes time for recovery. So he also often sometimes uses the phrase super debt cycle. But it's basically the same idea that you are sort of cleansing after a financial crisis. And the problem with that idea is that not every part of the world had a financial crisis, but a lot of countries which did not have financial crisis are still in limbo. You can then have individual explanations for that. The second problem with that is it is now 5 years after the crisis. The crisis started in 2007, 2008. We are in now 2015, going on 16. Why is it that even after 5 years, there is a problem? The third is that other studies, such as a recent study by Michael Bordeaux and a researcher at the Federal Reserve System, a study by David and Christina Romer, and any paper by David and Christina Romer has to be taken very seriously. They say, no, the Reinhardt-Rogoff results are essentially an artifact of the fact that they go back before the Second World War. They've got all this old data. If I look at post-war data, if I have a better definition of financial crisis, if I do the econometrics correctly, basically you should have recovered in 2 or 3 years. And that this notion that financial crises are somehow special is a bit of a distraction, and it's not what the data shows. Be that as it may, let us concede that financial crises do have some impact, but I think you still have to ask, why is the whole world wrapped up in it? And why is it that even after 5.5, 6, 7, 8 years, we are still in the throes of this process? At that point, we come into the second line of intellectual thinking, and that is this animal called secular stagnation. Okay? So I call it this animal because I've had a lot of trouble understanding what the phrase secular stagnation means. The reason is that in the phrase secular stagnation, as Larry Summers first proposed it, there were two concepts. One was that there is, in some sense, more than a normal cyclical decline in demand, which is why recessions occur. There is a secular decline in demand. That somehow the world, for a long period of time, is going into a contraction of demand. And then Larry, of course, threw in something about productivity growth and so on. So Larry had a mix that productivity growth has slowed down, but demand has fallen in a secular way. Paul Krugman is much more pure in his articulation of secular stagnation. Krugman only talks about a decline in demand. Krugman has an intellectual commitment to decline in demand. I don't know how to turn this phone off, so every time it comes, I'll just have to do this.
It's closer to Alvin Hansen 1930s version of secular stagnation.
I think so. I think so. The reason I'm sort of not giving you a clean answer is that I don't really know. But we can certainly say that Krugman is pure. He thinks only about demand, whereas Larry fudges. So in a little bit, I'm giving you a tour of what the writing is as I'm going along. And I would recommend for those of you who are interested, the Peterson Institute recently had a very good symposium in which Larry spoke again. And Adam Posen, who was chairing that session, forced this issue of demand and supply. And I thought, helped the discussion a little bit, because he said, what exactly do you mean by this demand decrease? And on that panel also was a guy named John Fernald, who along with Robert Gordon of Northwestern University have been very prominent in saying that the real problem is that world productivity growth has slowed down. That there is in fact something secular happening, but that secular that is happening is that world productivity growth has slowed down. And those of you who know Robert Gordon, I just say briefly, his view is that between 1871 and 1913, there was a stunning flowering of innovation, which then carried the world for almost a century, but that force has run out of steam. And while we are mesmerized by our recent new IT technology, these gizmos that we have are cute but don't add to productivity. Okay? And that this is not going to change in a fundamental way unless there is a real breakthrough. And yes, a breakthrough might come, but until that breakthrough comes, expect growth to be slow. Okay, so the basic model that I then use to think about these last 6-7 years has two elements. One is this underlying low productivity growth, which I think is very well established, not only by Gordon but by John Fernald. The data on this is pretty strong. And to my mind, very persuasive, and neither Krugman nor Larry contest it. Krugman just says, yes, but I expect a flowering. That's cool. Maybe there will be a flowering, but right now, to understand what is happening, what has happened in the past few years, and what is likely to happen in the next couple of years, you still have to rely on Gordon. So that's one element which I think is pretty robust in the data. The other element is that therefore, the period between 2003 and 2007 was a global bubble. Productivity growth had slowed down. The world was growing at these extraordinary rates during that period because it was pumped up. It was pumped up for various reasons. It was pumped up essentially in the United States through the consumer spending, which led to high growths in the US. But the entire world was pumped up. And this is my second sort of central element, that we have to think today in terms of a global economy, because world trade boomed during this period. So when the American consumer spent, what that meant is that they were buying German cars and textiles from China. So even where there was no housing and credit bubble, there were extraordinary rates of growth. Take Germany is a good example of that. No financial bubble, but 3.5% growth, which for German standards is extraordinarily high. And in a way, the German miracle that people talk about is just that, because up until 2003, Germany was being called the sick man of Europe, and Germany suddenly transformed on the back of this bubble and became an apparent economic superpower. So you have this phenomenon that you have an enormous growth fueled by some financial excesses in some parts of the world, but then transmitted to the world through the mechanism of global trade. And so the whole world participates in this bubble. When the bubble collapses, the first fault line is the banking system in Europe and in America. America then slows down. America slows down. America takes charge through various policy measures, which we can talk about. The Europeans who had exactly the same crisis from the same day say, no, this is not our problem, this is an American problem, because they deny that they have a problem till Greece hits them. So they lag behind in their policy measures. They then go into a protracted crisis in 2011 and 12. And by the time they come out of it, China, and then China becomes a really important part of this story for reasons that you will hear in the next few minutes. China in 2009 had imparted the world's most extraordinary stimulus. In 2009, in 1 year, Chinese credit grew by 30% of its GDP. So the increment to credit in 1 year was 30%. What does that mean? That means that BMWs and Mercedes and machine tools and high-speed rail, the Germans were gushing that stuff. So China picked up the world economy in 2010 and kept it going in 2011. Europe was slowing down, and by 2012, it was clear that the emerging markets are not going to keep it up. The Chinese basically transmitted that stimulus into the world through trade, the commodity producers, the equipment producers. And so there was, even in the midst of the European crisis, there was a sense, if you see the VO reports, yeah, but that's okay. There's this two-speed stuff happening. You know, the advanced economies are going one way, but the emerging economies, they're resilient. There was this very a nice essay, The New Resilience of Emerging Markets, done by one of my favorite economists, Abdullah Abiad. And that talked about how emerging markets had put in place institutions during this phase of growth, which were going to be robust to a crisis. All the time not seeing that robustness arose essentially from this sense of prosperity between 2004 and 7, which made, in prosperity, everybody looks good. And so those institutions look good, but they were not ready to withstand the pressures of a proper crisis. And in any case, China was never going to be able to withstand it because China was too pumped up. China was too pumped up even before that. China had been growing at a rate that it could not sustain. And China needs to slow down to a growth rate that's closer to 3 or 4%, but it tried to keep it going. And therefore, the Chinese slowdown has to occur. So, the first part of my story is just complete, which is that the reason the crisis has lasted as long as it has is that with an underlying low productivity growth in the world, the bubble that opened up between 2003 and 7 has taken its time to unfold. First US, then Europe, and then China. And the reason China is important, has been important in the last 7 years, and will be important to the second part of my story, which will be much briefer, is that China is the fulcrum of world trade. China is, in that sense, the world's most important economy in the world today because China determines the pace of world trade, and with that, it determines how high the global tide is rising at any time. So therefore, I don't need secular stagnation. I don't need extended financial distress to explain why this crisis has lasted so long. I need all my parsimonious model requires is there's underlying low productivity growth. Therefore, there is nothing to compensate while this bubble is bursting, and the bubble is taking time to burst because China held it up for a while and China can no longer do so. Then the question is, what should we expect going forward? So we saw these financial tremors first late last year. They went away. They just came back. And now the question is, so there was a host of commentators who in the last 3-4 days said, markets have got it wrong. They are panicking. There's a herd instinct over here. And so the question is, let's think about that. And how should we think about that? And here, my sort of model is, I call it model, but my sort of way of thinking is influenced by a Danish physicist who died young, very brilliant physicist named Per Bach, who asks the question that earthquakes don't happen for a long time. And then they happen in quick sequence, one after another. And why is that? So he said what happens is that when the first fault line is disrupted, then the shock waves it sends weakens other fault lines. And then the next fault line then has an earthquake, which sends more shock waves. And so there is a transmission of shock waves which weakens the vulnerable. So if there are vulnerabilities in the system, if there are fault lines in the system, you may not see them exposed for a while, but when one of them is broken, then there is a quick transmission, and so you see a succession of them. So here is how I then use that idea to think about the next phase, because what that does is it says that there are nonlinear possibilities. So the crucial analytical point over here is, so a lot of people who do this and say, why is China not important? Is they say, well, you know, America imports, import to GDP ratio is 20% of GDP. I forget, Josh might know the number of that. We import only so much from China. So if XYZ happens and we export only so little to China, if China falls, it has an impact of 0.1% on our GDP. And even if I take second round effects and world economic effects, it adds up to 0.3% of my GDP. Well, it's a wash. So if you do a sort of purely linear model, that's what you get. And maybe that's what will happen. But I think what markets are worried about, and I think the markets have a good reason to worry about, is that there are lots of fault lines in the global system still. And that China itself is a major fault line. And that when China inevitably slows, and even if China does not have a crisis, the extended slowdown of China while it unravels its political and governance process and adapts to a new system of economic governance is going to be disruptive any way you look at it. And as that process occurs, it is then going to have an impact on the other vulnerabilities in the world. So what are the other vulnerabilities in the world? So China itself, Europe is a very important vulnerability in my mind. So of course most of my scholarly work is now on Europe, so I have a little bit obsessed by Europe, and so I might somewhat overstate it, but Italy, Italian non-performing loans are at a high. Like the rest of Europe, Italians have not done anything about their bad loans. Their credit to GDP ratios were astronomically high before the crisis. They've come down slowly, but essentially Europeans have looked the other way while their bad loans have festered. We had a mini crisis in Italy a few days ago. Italy is going to now have to support its banks. Its debt to GDP ratio is already 135% of GDP. And Italy has not grown. Italy has not grown for a generation. For those of you who don't know this, it's a striking fact that Italy joined the European Eurozone in 1999. Italy's per capita income today is lower than it was in 1999. And this is not just an effect of the crisis. Italian per capita income was the same at the start of the crisis as it was in 1999, and it has fallen since. A country that does not grow is not going to pay its debts, is not going to honor its ability to repay its loans. Italy is the biggest other fault line outside of China. Greece continues to be a fault line. Greece has gone into a little bit of a sideshow because Europe is so overwhelmed right now with other problems. But there is a war of attrition going on between Greek creditors and the Greeks. Wolfgang Schäuble, the German finance minister, has already started new noises about a new discussion on Greek exit from the Eurozone. If Greece exits from the Eurozone, I think economists should not be in the business of making predictions, but I think I can say with near certainty that in the next 10 years, the Eurozone will unfold and unravel. Because the proof that a country can leave the Eurozone would have been established, and then Portugal and others will have to deal with one wave after another of speculative attacks. The United States itself is still struggling. The fourth quarter results in the US are looking really weak. Industrial production is down, corporate profitability is down. The US fourth quarter results, according to the Atlanta tracking system, look really weak. The world economy at this moment is again in a fragile situation. If the Europeans have a big refugee crisis, which they already have, and they're not able to handle it, and it blows up, there's a lot over here that can trigger another crisis. And this is not sort of speculative, this is already happening, and I think markets are right to worry that there is some nonlinear possibility over here, and that therefore there might be some relatively extensive correction. Markets are not looking at a median growth forecast. Markets are looking, in my judgment, at some kind of a tail risk, and I think there's an elevated tail risk at this point. So I'm going to wrap up by saying that there are good reasons why the world economy is growing slowly. why it has taken so long for it to get out of that initial shock, why therefore at this moment there continues to be important sources of risk around the world, and that as long as global productivity growth remains low, these fault lines will remain a source of vulnerability, and the ability to pull out of them will remain a great challenge. All of this, just to conclude on a little bit of a more philosophical note, is, in my judgment, we are going through an important phase in global economic history. We are going through a phase in which the political and economic governance system of the world is undergoing a fundamental change. What do I mean by that? What I mean by that is that in these years, the sort of Clinton years, there was a certain view, let me call it the Clinton era. There was a certain view that there was going to be prosperity. And the governance system of the world was set up on that basis. I think people have realized that that is no longer going to be the case, and that we have to change our expectations of what we can expect in the next generation in terms of the dividends that the world economy is going to give us. Therefore, what is happening is that a lot of people are getting left behind. So this is sort of what in America is known as the white male phenomenon, which Angus Deaton has recently written about, is that this whole group between the ages of 45 and 60 are suddenly getting left behind. They're getting left behind not just in the sense that they are getting left behind, but in relation to their expectations, they are getting really left behind. And this might sort of seem an odd way of saying this, but in Europe, there are lots of white males, even more so than in America. And they are getting left behind because Europe is going to grow really slowly. Europe has these large welfare states, which is not going to sustain. And people are beginning to see that those welfare states are not going to deliver on the promises they've made. Therefore, there is a broader political uncertainty about what will replace this system that we have taken for granted for such a long time. And so the economic challenges that are coming right now are coming in the midst of a broader political upheaval, of which Trump and others are a phenomenon. And Marine Le Pen and Trump and all this is sort of a throw up of this basic economic phenomenon at a time when there are lots of economic vulnerabilities in the system. So if there's sort of one thing I want you to take away from this talk, is that in the midst of this political and economic governance challenge that we face, the vulnerabilities create lots of scope for nonlinearities in economic outcomes. And that's basically where we are right now. Okay.